Okay, chapter 4. The next part of chapter 4, the beginning of chapter 4 talks about why do we need adjustments. All right. Well, adjustments are here because of us using accrual-based accounting. At the end of each period, we have to go through and we have to be able to say what happened during that period that we did not record. Because revenues are recorded when they are earned. So if we recorded all this deferred revenue, at the end of the period, we have to go in and say, okay, did we earn any of it? If we recorded all of our expenses as assets, we have to go through at the end of the period and see if we earned any of that or used up any of it. So adjustments are needed or financial statements are going to be under or overstated. All right, so we have to represent those amounts on our balance sheet as liabilities and assets and on our income statement as revenue and expenses. All right, so there's two different types.
I can't see your screen if you...
Okay, I wondered. Something changed on mine. Okay, so deferral adjustments basically are, you don't have to memorize these two types that you're going to hear about, but deferral adjustments are two types of adjustments, are adjustments in where we pay for things up front. Oops, I got to turn it on. Pay for things up front, and then adjustments need to be done later. All right, I'm going to show you a specific example of these in just a second, okay? And the type of deferral adjustments, if my screen will move on me. Come on. All right. Hang on. You guys are like seeing not even a full screen. Let's fix that. There we go. All right. All right, so I just showed you those two. So we pay for it and then we do an adjustment. All right, a couple things to help make things a little bit easier for you guys if you need little tips is deferral adjustments, decrease balance sheets accounts, and increase an income statement. And they always involve one asset and one expense or one liability and one revenue. Down here, they give some examples, but I'm going to write them out for you in 1 second. Before I write them out, I'm going to tell you the definition of accrual. Accrual is when we haven't paid for them yet. And we're going to record the adjustment first, and then you pay. So income taxes and interest are examples of those. We record the fact that we have some type of adjustment, interest expense, income tax expense, but we haven't paid for it and we'll pay for them later. They always have a revenue and an expense as well. All right. And you're going to pay the cash later. Again, one asset, one revenue, one liability, one expense. Always the same type of thing happening. So let me pull up a whiteboard. All right, so there are basically 9 adjusting entries that we want to talk about. All right, so the first I usually talk about are the deferral journal entries, and I'm going to try to write small. So we have our supplies, expense, and supplies. Right? That is, I'm going to move that over a little bit. Hang on. It's still the same journal entry. I'm just going to move it over a little bit. We have our supplies, expense, and supplies. And basically, what already happened is we purchased the supplies and we paid cash, but we didn't use them yet. Now it's the end of the month and we have to go out there and figure out how much did we use and record the fact that we used them up. Another example is rent expense and prepaid rent. We debit prepaid rent and credit cash, when we pay for 6 months of rent, but as we use up the rent at the end of the month, we have to account for the fact that we used it up. Same with insurance expense and prepaid insurance. Prepaid insurance and cash. And then one other one that goes over here would be deferred revenue and run revenue and credit revenue. And what happened at the beginning was cash and deferred revenue. We got paid for something we hadn't done yet. And then later we recognize it. So notice in the first column is what happened during the month. This is during the month. Wow, what happened? Hang on, it's coming back. Okay. This happened during the month. It just did it again. Why is it doing that? I think I'm touching an arrow. Let me try writing lower. Okay, during month. And this is the end of the month. So during the month, we bought supplies and paid for it. At the end of the month, we have to see how much did we use. At the beginning or during the month, we paid for rent. At the end of the month, how much did we use? Right? Those are all deferral. Again, you don't have to memorize that, but things that we pay for up front, we recognize at the end. The other ones were called accrual adjustments because we haven't paid for them yet. All right. Now, the first one is the only adjustment that we have where we never spend cash, and that is depreciation expense and something called accumulated depreciation. And we will talk about that in a few minutes, but that is the only one. Okay, Adam is out because they lost all internet. So I just got a text. That one, nothing ever happens. That is our only adjusting entry. Okay. But the rest of them would be, examples would be wages expense, wages payable. And then later, wages payable and cash. Interest expense, interest payable. Later would be interest payable and cash. I had also mentioned one of the ones, income taxes. Oops, sorry, the income tax expense. Income tax payable, income tax payable, and cash. And then we have, on the other side of interest expense, we could also have interest receivable and interest revenue. So we're recording the fact that we earned it, but we collect the cash later. And then the last one, I don't really consider it an adjusting entry, but your book does. And that is accounts receivable. I just was doing the same journaling. Accounts receivable and revenue. And then later it's cash and accounts receivable. So, again, this is what we would do at the end of the month to recognize that we need to do something. We need to record depreciation. We need to record wages, interest, income taxes, interest receivable or accounts receivable for revenue. And then later, the cash would be received or the cash would be paid. we don't care when necessarily from the book standpoint, but what's in between these two lines have to be done in order for our financial statements to be accurate. So there you will see a total of 9 journal entries or 9 adjusting entries. I don't really think that one is one, because I really feel like when you have accounts receivable revenue, you do it at that time, but your book has it. So I'd like you to see, what is one thing that you see a lot of? What do most of these adjusting entries have in common?
Cash.
No. Inside that box, do you see the word cash at all? No. So adjusting entries, oops, I changed it to a highlighter before I never have cash. So adjusting entries never have cash. Now, cash is involved before and after, but never in the adjusting entry. Look at each one and see if you notice something. Look at each debit. What do most of them have?
Expense.
Exactly. Almost all of them have the expense. 1, 2, 3, 4, 5, 6, 7 of the 9 have 10 have the word expense on them. Interest receivable, accounts receivable, and deferred revenue are the only ones that don't. So if you're looking at adjusting entries and you're trying to figure out what it is, if you take a look at expense, it's a good guess. All right. Now, the other thing is, look at what I have before and after each one. They all deal with what your journal entries are. So there's not a lot of guesswork. I dealt with supplies, it's supplies expense. I dealt with prepaid rent, it's rent expense. Over here I said interest, it's interest expense. Wages, it's wages expense. So they deal with what we're actually talking about. Okay, does everybody have what I have written down? Or you can come back and look at it, but okay. I'm going to go to the next slide. Go through this. All right. Let's go and look at a